over the big tax cuts, we don't have the money for that. So that's when everybody started to go and buy gold. Now, when I say everybody, I'm talking about the big boys. I'm talking about the central banks around the world were just buying. They didn't want our treasuries. Remember, every month we have a treasury auction, and we tell them, hey, we need some money. Please loan us money. We'll give you the treasuries. They said, to hell with you. We don't want treasuries anymore. We want gold, because your dollar's getting worth less and less as these tariffs and all the spending and the debt and the deficits, and no, we're going to stick with gold. So what happened was that the hedge funds on Friday, the big central banks, insurance companies, mutual funds, they put money into the pool, into the Fed pool. There's two ways of doing this, and I'll keep it simple because it gets so complicated. The Fed, the banks can go to the Fed and they have reserves. And every bank has to have a reserve account with money in it in case they'll take care of bad loans or so forth. Well, they can go take that reserve, go to the Federal Reserve and say, hey, we're going to loan you some money and we just want some interest. And usually that interest will cover over and mask their problem. Now, if you look at this chart, the problem is they have all these, they're on a run rate right now of delinquencies or repossessions, never mind delinquencies. They're repossessing over 10 million cars. That's their run rate. That's what they're going to hit by the end of December. So they don't have enough reserves. So here, take a look at the chart. Look how the reserves have fallen in these banks. This is incredible, from 2022 to where we are today down here. It went from 4.2 trillion down to 2.8 trillion. So they don't have that money to go and say, hey, Fed will give you a power. Let me loan you the money and you give me an 8% interest rate or whatever, and that will carry me over. Well, they don't have that. So the emergency came with the other system they have is that they can go and borrow money. Now, the 5 biggest commercial banks put money in the pool. You have hedge funds, mutual funds, insurance companies. They plug the money in there, and banks can go borrow it. And so again, there was no dollars. That's where the emergency came in. So they needed $50 billion, and because everybody's been dumping their dollars, this thing was a real crisis. But nobody cared. Nobody really cared. So now what happens is these banks, the reserves are really, really low. Okay, that's bad news. There's no dollars around. So the problems are, you notice the yields today, how they're going up? The yields are on their way back up. Now, what's that mean? Well, first of all, you better be concerned if you're in tech stocks, gold stocks. And that's what caught my attention on Friday. I started seeing my gold going down again. I mean, we did fantastic in our gold. They're still very healthy, big profits. We took most of our profits off when October 8th came and gold hit 4,100. I said, time to sell into it. Then on October 10th, the banks came out and they said, we got a new target, 5,000 an ounce. That's what I told my gang members. I swear to God, they'll tell you this. I said to them all, now you got to dump. You got to start selling. Don't get out totally, but take a lot of your profits because we were up big. As soon as the bank pushed 5,000 an ounce, bam, everything started to turn around and go south. Now, with the fact of this repo, where there's the banks are in trouble, they don't have enough money because they're carrying these loans, and they don't want to show them as losses. They don't want to show them as losses, so they're borrowing this money. Now, what happens is the yields are rising. Go take a look at the yields on the 10-year Treasury. Here, I'll put it up for you right here. We'll do the 10-year Treasury yield. Oh, this is a great chart. Here, I'll talk about that in a moment. That's a great chart. But if we go over and we look at the 10-year Treasury yield right now, the 10-year Treasury yield, look how it's starting to shoot right back up again. See it right here? Shooting right back up. Now, what does that mean? Well, it means that's a real problem because, again, rising yields will lead to a correction because now you got increased borrowing costs. So remember, rising yields. So that's why we talk about it every day. Watch your bond market. Watch your bond market. The bond market would tell you the direction the stocks are going or the stock market's going down. If you're going to have a correction or a crash, the bond market is the only place you can go to tell you the truth. And it did tell us the truth. So the rising yields we have right now can lead to correction. Here's why. Here's what happens. When you have rising yields, and it's, by the way, hurting tech, stocks, gold, not much yet, not much. I told my gang members, it's going to take a few days to sink in, and it may not sink in at all. I said, tomorrow morning we may wake up and everything's up 200, 300, 400 points again. Nobody cares because people think, hey, I got my 6 tech stocks that go up every day. They've been going up for years. I'm not going to get out. I don't care about the dollar. What do I care about the dollar? I don't care. I mean, they don't realize the dollar, when you got yields and yields are going up and the dollar's going up, then you're hurting tech stocks, gold, and Bitcoin because they're less valuable due to the rising yields that we see right now. Because remember, as yields go up, remember how yields, they increase the discount rate that is used in stock valuations. Remember that. So as yields are going up, it's making your tech stocks, your gold stock, your Bitcoin less valuable. Because remember how they judge the value. Because the valuable is due to the rising yields. And as they increase the discount rate that they're using, the stock valuations get worse and worse and worse. Now, but it seemed like today everybody kind of fell asleep. The Dow's down about 223. That's not much. And I said this morning. I said, it's like nobody cares. And the NASDAQ I think it punched near 300 today. It's only up now 110. And the S&P is about flat, up about 12. That's it. So it's like a yawn. Nobody seems to care. So again, what's happening is when you have the rising yields, keep your eye now on your tech stocks, especially the semiconductors, and watch your gold stocks. Make sure you have a short position on them. And that's another thing that's bad. The reason that 90% of people lose money in the stock market is because they have to trade to perfection. Nobody's that good. If you say, I'm not going to learn how to short, I'm just going to buy and hold. Don't worry, I'm going to be fine because these 6, 7 tech stocks. Remember the S&P, I've told you, there's 290 out of the 500 stocks. They don't even have earnings. You got 10 stocks that has earnings. That's it. And you got the same tech stocks that go up every day. So this repo market, it pulled back the mask to show you what's happening, that we're in a worse situation than we were in 2008 when it comes to these banks. But nobody cares because it's the same stocks going up every day. But we're going to look at the stocks. But here's the other thing why nobody cares. If you look at this guy right here, you can see, look how the money supply, okay, and margin debt. I told you the other day, as long as money supply keeps being increased, and that margin debt, remember, comes from that money supply, as long as they keep expanding your margin debt at your brokerage on Wall Street, right? Wall Street keep expanding your margin debt. That's what they're doing. And here you can see it. Look at this. This is insane. Here you got the S&P in light blue right here. And what's pushing up the S&P? What's pushing up the S&P is the margin debt. We never had margin debt like this. So between the margin debt that comes from the money supply, and Wall Street's clever, saying we're just going to keep plugging money into the margin debt accounts, so the FOMOs will keep coming in. The FOMOs are the people who are scared to death they're going to miss out. They never get in right. They always get in at the top. They never get in where you're supposed to, call the sweet spot that we teach all the time. Never get in there, and they're the ones that take the whole market down, because the minute they get the first margin call, they don't write a check. They say, dump, get rid of my stocks, get rid of my stock. That's what's going on. But here's another thing that's going on. Because they have margin debts going up, the money supply is going in, the margin debt's the leverage, everything looks good, everybody looks like they're rich. And here's what they do. They lie to us every day. Listen to this today.
The consumer's in solid shape, and that spending is at a healthy level. It's not...
Wait a minute. Healthy shape? They just came out and needed to get, there's 10 million cars in repossession. How can he say
the consumer's in solid shape?
With 10 million cars in repossession, what's this guy, nuts? This is crazy. They're going to hit that target at 10, I think it's 7 million right now. They're going to hit that 10 million. So this is crazy. Hourly wages between 2020 and 2025 are up just 5%. But the average auto cost going from $38,000 to $50,000, 31%. So in 5 years, cars have gone up 31%. The same 5 years, wages are going up 5%. And the home costs have gone insane. They've gone up about 30%, something like that. But he's telling us
the consumer's in solid shape.
Yeah, he's in solid shape, all right. He's screwed with his wages. And right now, if you think about it, home values have increased. Let's see, I just want to get the right number here for you. While the home values went up about 49%, the savings have dropped to 2.3% flat. And job openings, consumers aren't spending because they're scared to death, because job openings have declined from 11 million to 7 million. So people have no savings, they have no job openings, and their savings is the lowest ever. Home mortgage delinquencies are the highest in 17 years. Car payments, delinquencies highest in 33 years. Credit cards, the highest in 30 years. And minimum MasterCard payments and so forth, they're at a 12-year high. Everybody's paying minimum. And household affordability gap's 57%. And household expenses have gone from 30%. When you get your paycheck and you go home at the end of the month, you pay all your bills, it used to be 30% household expenses. It's 49%. Savings dropped from 30% to 2.3%. And he's telling us everything's just fine.
The consumer's in solid shape.
Unbelievable, isn't it? So what do you do? I'll tell you when we get back.
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
When you listen to the advice of Phil Grande at philsgang.com, you'll find investing in the stock market makes sense with the right guidance.
People keep saying to me, boy, things are hard, things are tough. boy, the market's really screwed up. And I don't agree with them. For us here at Phil's Gang, we make it so it's simple. It doesn't matter if the market's bad or good. We consistently do well because we make it simple. And just like for my listeners on the radio or on the internet or my podcast, we make it simple. We try to break it down so you really understand why the market is going up or why there's continued inflation or why the bank rates are going up. So you understand, especially yields. The most important thing to understand how yields work. Just what we do. We work hard at it.
Trusted advice, easy to understand strategies that will make you a better investor. Get all the details at philsgang.com. That's philsgang.com. Welcome back. Are you ready to make profits in the stock market? Why not check out philsgang.com or give us a call, 877-600-4264. Now, here's Phil.
And welcome back to Phil's Gang. Join my gang, philsgang.com. Okay, so when you look at this chart, and we'll look at the margin debt and the S&P 500, the values, and you can see clearly this is the biggest bubble we ever had because we've never seen where we have increased the money supply so much. It's historic. And that's what's pushing up the stock market. And then they turn around to take care of the FOMOs. And they say, Wall Street says, let's take enough of this money that we're printing and let's make sure that we keep increasing our margin debt accounts. Let's chuck them full of money so that the FOMOs or the tourist investor who doesn't know what they're doing. Remember who a tourist investor is. Tourist investor is not a retail investor. He's a gambler. He's impulsive. He's doesn't want to learn. He's always driven by fear that he's going to miss this rally. And you can see what's going on in the market. They're giving him enough money to make sure every time the smart money dumps their tech stocks, we don't see it because they're right there borrowing money from Wall Street to prop these tech stocks up. That's what they're doing. That's how they're getting away with it. And so, again, they are impulsive. They're driven by fear. They always buy at the very, very top. They never buy in the sweet spot. Sweet spot is where you make all your money. That's the majority of the money on your chart. It's called the sweet spot. And I designed my own chart so everybody, my gang members, can pick it up quickly and fast, and that's where they get in. And then, of course, you got to learn how to sell short, because if you don't know how to sell short, you're so screwed. Because when the market starts going down, you just sit there and you lose all your money. If you're in a 401k, you lose all your money. Well, you don't have to lose your money, because you can turn around and short, okay, the spiders. Or you can do an inverse on the spiders. So there's a way to protect your 401k. We'll show you how to do that. Now, I'm saying to my members, I'm not so sure that this market's up for a crash anytime soon. And I'm just watching how it's behaving today. This is a serious deal that went on Friday. Banks are hiding about $500 billion in losses. You got the Fed, okay, and that has their program. We got people plugging money into that pool. And what the problem with it is the interest rates, the yields on the Treasury are too high, and that could cause a crash, or a correction. But then again, you think about it, and you look at the money going in, and how much money they're putting in the margin debt accounts. You're going, I don't think so, because they're going to keep buying the same 5, 6 tech stocks. They go, you know them all, NVIDIA, just any semiconductor, just buy the semis. Here, give you an example. The ones that we always concentrate on every day, we go right to them first thing, okay? Let's get it right here. Okay, this is all tied to AI. The first stocks that are the most important, that are so tied to AI, it's insane, is the semiconductors. So if you take the ETF, right? I mean, making new highs. It's almost making another new high today, or it's trying to. And see, this is what I'm saying. Nobody cares. Nobody cares about what happened on Friday, that the banks are in trouble. But worse, what people don't understand is all this money that they're lending and they're making us pay high yields, that's going to start killing the tech stocks, the gold stocks, and the Bitcoin. Unless there's so many FOMOs out there with margin debt, it'll just mask it and the market will just keep going up. Now, you look at NVIDIA, that's another one. Okay, look at that stock, new highs. These are the stocks we're in every day. MU, beautiful stock. We call it that stock a power stock. We made a ton of money on MU. Intel, AMD. So those ones I just gave you right there. Those are the key semiconductors, okay? Now you go back and you break it down and you stay with, if you stay with these stocks right here, if you stay with the chip providers, there's NVIDIA, AMD, and Intel. Those are the big ones right there. Those are the big chip providers. And then, remember, TSM, Taiwan Semi, they manufacture so almost everything they have to Apple. Look how Apple's doing, okay? And we're long in Apple. And then again, NVIDIA, again, they're part of they get all their chips from TSM. And then you look at, there's the cloud providers. Now, Microsoft, we're short Microsoft, but look at Google, how strong Google is, and Amazon. So if you look at these and you say, my God, nobody cares about the fact that yields are going up. And if yields are going up, that means that they're very vulnerable, okay? Because what's happening is these stocks, tech, gold, and Bitcoin, are less valuable due to the yields that are going up. Because remember, they increase that discount rate that's used in the stock valuation. So these stocks, as they keep going up, the valuations keep hitting these stocks and keep hitting them, they become less and less valuable. So one day, all of a sudden, you can get a big gap down. But as I said, and I know I'm repeating myself, but the point is that nobody cares and they just keep buying. And as long as you got that, what people don't understand, as long as you got that margin debt account, Wall Street keeps those margin debt accounts full of money and keep the FOMOs in there and let them get deeper and deeper in debt. As the valuations start taking down your tech and your gold and your Bitcoin, you don't see it. And see, that's the game they're playing right now. So that's not good. Now, just to finish this up, if you stay with the top stocks, your chip providers, and you stay with the cloud providers like Amazon and Google, if you stay with and there's smaller ones, I'm talking about the big ones. If you stay with the infrastructure supports, like Micron Technology, we've been in that one a long time. Look at that stock, just keeps going up. They're not being interfered with. Now, if you look at the ETFs like ARK, that stopped going up. That stopped going up. That hasn't. It's the last time it made a new high was on October 8th. It's struggling. It's struggling now. Now let's take the MAGs, the ETF, the MAGs, Magnificent. They keep making new highs. And again, as I told my members, again today, if it makes another new high over $69, they can add to that again. So that's where all the money is, right there. You don't have to be in anything else. And if you just take the semi group, just do SMH, that's the whole group. Okay, that's their whole ETF. That's where they all are. And don't waste your time going anywhere else. This works. So that's what's going on, okay? And so, and again, don't jump into, I know everyone says, well, I want to switch into some value stocks, right? Well, the value stocks, Coke's not going to do anything for you. Those stocks, they're not going to protect you. None of those stocks, McDonald's not going to protect you. Starbucks is not going to, but why would you want to be in those? Johnson & Johnson, but they're struggling. Okay, Walmart's struggling. When you hear, well, go into the value stocks, all right? Because now, if we have the rising, if our yields keep going up, then you want to be into the value stocks. Well, I just I'm sorry, if the rising yields want to be a value stock, just stay with tech, okay? Now, remember, the one thing that's good about the bond market that will keep you out of trouble if you know how to sell short. And remember, the economy's in deep trouble, but nobody cares. They think the stock market's telling you the economy is healthy. Hell, we have consumers right now, okay? Bankruptcies are up almost 30% over last year. Business bankruptcies it was at 47, now it's at 52. But here's the real problem is our debt. Our total debt is $100 trillion. The national debt, if you break it down, is $38 trillion. Corporate debt's right now is, I think it was 22. I think it's now 32 or 28. I have to check that number for you. And of course, household debt is going absolutely nuts. And the deficits, Congress keeps spending more money than it takes in tax revenue. All of this is going to show up. It's all going to show up and take this market down. But we haven't had to worry about it because, again, they make sure that they keep these margin debts full of money, and they keep making sure they keep increasing this money supply, and everybody's buying the same 7 stocks. That's it. So that's what's going on. Listen to this.
And so you have this two-part economy. The easing of the rates is because.
Sorry about that. Let's try this one. No. Okay, we'll have to get that offline.
Here, 1 second.
All right.
All right, go ahead.
Okay, we try it again. Sorry, guys.
And so you have this two-part economy. The easing of the rates is because most of the economy is elements of weakening. If you're looking at a lot of the economy, you see a weakening in that kind of economy. At the same time as there's this bubble going on developing. So a monetary policy for both is not going to work because of that element of divergence. So I think it's probably going to produce more of a bubble.
So the thing the other thing you can watch, okay, is TLT. That's a bond, okay? This will also help you stay out of trouble. They don't want you to know about TLT. They don't want you to know about it, okay? But it's a good tool to watch because it can tell you, all right, is this market ready to crash or not?
3 minutes.
Anything that's in the bond market it will never lie to you. It just won't lie to you, okay? So if you look at TLT, and that right here, let me put it up for you right here, TLT. If you go all the way back on TLT, and you can see how right now it's been struggling, okay? And it's really, if you draw a line from December 2023 straight across, we've been in a consolidation since since December 2023 to today. We've been in a consolidation, okay? And TLT will help you because if the yield keeps going up, it'll send you a message. Okay, then the dollar will go up. If the yield's going up, the dollar's going up, and it's telling you gold's going to start coming down. It's going to start backing off. I'd say 99% of people who are in the stock market don't even know that. They have no clue. So that can help you out big time, okay? Just know, especially a lot of people have been buying gold, but they don't know how to watch it. So again, if TLT's down, that means your yields are going to go up, okay? And the dollar's going to go up, and you're going to have to start shorting gold, and you're going to make money. And if TLT instead, and you can see TLT right here, okay? You see how TLT's coming down right now here? Look at, I'll push it over here 3 months. Look how TLT is dropping. So TLT's coming down, okay? And if you got, again, TLT down and yields are up and the dollar up, which they both are, then it's telling you better go look at your gold. All right, so let's put up gold. We'll put up GLD or GDX right here, right? Let me get it in there if I can. Okay, GDX. So all I do in the morning, I look, I put up my TLT, I see it, okay, my TLT is on its way down. I know my yields are up, my dollar's up, so that means my gold's going to be coming down. Let's see if it is. I go to my GDX, boom, sure is, right there. So it's telling me don't be buying GLD, don't be buying GDX. Look how simple that is. Just by knowing how to read the bond market. Just read the bond market, read the TLT market. That's an easy one to read right there. So you always know what your stocks are going to do. The bonds never lie. They never lie. So, and just the opposite, when TLT goes up, okay, in price, then you know investors are purchasing these bonds because they're looking for safety, because they're fearful, because the economy's slowing. So just knowing a little bit about the bond market will teach you how to read it. It's so easy to read. It'll keep you out of trouble. And learn how to sell short. We'll help you with that too. Join the gang, free for 10 days.
You have been listening to Phil's Gang with your host, Phil Grande, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.
It's up to me.